Okay, today I'm going to start a new topic, the business income. I presume that we have discussed employment income and we have done some model questions as well. So, as I explained to you all earlier, under the New Inland Revenue Act, there are 4 different sources of income: employment income, business income, investment income, and other sources of income. So now, since we have discussed employment income, now we are going to discuss business income. So this is a bit more complicated area, not like employment income. So what you got to understand, so if you have a very good understanding about business and how business is computing profit or loss for a particular year, so that will be very much useful in understanding the business income for the purpose of income tax. So let me first commence how we calculate profits or loss for the purpose of accounting. Profit or loss. We calculate income minus expenses. This is how we do in financial accounting. Okay. Fine. But remember, for the purpose of income tax, we don't necessarily calculate profit or loss from the business. So we are going to make some adjustments to the profit that is already calculated in the financial statement, in particular the income statement where you will find the profit or loss. We convert the profit or loss that has been already calculated for accounting purpose in line with the tax law in order to convert into the business income. Now, in this process, what you got to understand very clearly, in accounting, when you calculate profit or loss, in accounting, when you calculate profit or loss, you could remember it is not only the income that is arising from the business, the main operation, but also certain other incomes such as interest, dividend, rent income also will be considered as part of the income generated by the business. But when it comes to taxation, now it is very clear what the tax law says. You got to consider only the business income. In other words, income which is generated as a result of business activities. So now say for example, if it is a manufacturing organization, the manufacturing organization income, the business income means the sale of manufactured items. But when you look at the income statement of the same manufacturing organization, you may see the profit or loss already calculated may reflect not only the sales generated from the manufactured items after selling. Apart from that, there may be other incomes such as interest, dividend, rent, and so on and so forth. So therefore, you cannot take those other income which are not effectively connected to the business operation. If anything is effectively connected to the business, yes, you can consider such item as part of the business income. Let me illustrate further this concept. It is very, very important to identify an income, whether it is business income or it can be considered as investment income or other income. Okay, now I'll take interest income. Interest income. Now, if I were to ask interest income, obviously most of the people will say interest income is an investment income. It is not the way that you have understood or way that you have been taught in the past, you will have to look at how this interest income is earned by a person. It can be an individual or it may be an entity. So now say for example, individual, typically they may earn interest income by investing in bank or financial institutions, investing in fixed deposits or maybe in savings account or maybe even corporate debt securities like debentures, commercial papers, etc. So there you invest and then earn interest income. That is obviously, it is investment income. But now, say for example, a bank or a finance company, they also earn interest income, but how do they earn? They carry on a business activity, lending money to public and earn interest income. So in that case, the interest income for a bank or a finance company is not investment income, which is business income. And for an individual, if they invest in fixed deposits or treasury bills, treasury bonds, debentures or commercial papers or savings accounts for that matter, so then the interest income earned by an individual shall be regarded as an investment income. But now let me take another example. Now interest income earned by a manufacturing organization, also it may be like this. A manufacturing organization can, surplus money can invest in fixed deposits. Or maybe in treasury bills or treasury bonds. So then any interest income earned by a manufacturing or a trading organization, apart from their normal business activities, then such interest income shall be considered as investment income. But same way, there can be certain interest income that the manufacturing entity or the organization would have earned in other means, such as charging interest on outstanding debt balances. On outstanding debt balances. Now, if you would have studied in accounting, so when you make credit sales, you offer a certain number of days or maybe weeks for a particular customer to settle the dues. So 1 month credit or maybe 45 days or 21 days, something like that. Now, if there is a delay on the part of the customer in settling the outstanding amount, the company can always charge additional interest. That also considered as an interest, but can that be considered as investment income? That is the question. But it is interest income on the outstanding debt balances. But the question whether we can consider that interest earned by a trading organization or a manufacturing organization, can that be considered as investment income? Because it cannot be considered as investment income. The reason is, if you do not have this business activity, trading or the manufacturing activities, there will not be sales, there will not be credit sales, and there will not be a question of charging interest on the outstanding debt balances, because there is no business at all. And then there can't be any interest on the outstanding debt balances as well. So therefore, this is effectively connected to the business. So this interest income that particular organization earns is effectively connected to the business. So therefore, this effectively connected concept is very much important in distinguishing or in separating an income, whether it is falling under the business category or whether it is falling under the investment income category. So that is very, very important concept. That is one. Another one, the rent income. Again, the question is whether the rent income is investment income or business income. Is it investment income or business income? Or business income. Again, you will have to look at how the person who earns this income, what is the motive behind and how the activities are carried out, whether there is an intention of carrying on a business or whether there is an intention of conducting this as an investment activity. So now when we later talk about, we are going to talk about investment income, and in the Inland Revenue Act they have specifically defined what is and how the investment income is generated. And investment income is generated from an investment asset. So then we will have to look at what is an investment asset. By holding such investment asset, if a person earns income, then that income will come under investment income category. Now let me take an example here to elaborate. Now say for example you have a building and you are conducting a business, and this building is conducting a manufacturing business. Say this is a 3-story building, and initially, since you just started the manufacturing business, you are not fully occupying this entire building. So one is vacant, this floor is vacant. Suppose this second floor is vacant. But you know the fact that maybe in the time to come with the expansion, you need this second floor as well. But until such time, no harm, you can rent it out and earn income. Then when you earn by letting this vacant floor, you earn the rent income. There is no doubt. But the question is, which basket this rent income will fall into? Whether it is coming under the investment basket or whether it comes under the business basket. That is the question. Now here, again going back to this effectively connected concept, because this building predominantly is used for the business. It is utilized for the business, but since there is surplus or excess space, that can be rented out and earn income, but no, whenever it is needed, this vacant space is needed for the business, they are not going to earn rent income anymore from that vacant space, and they will occupy that vacant space as well. So therefore, the rent income is earned by renting this vacant space for a shorter period, but the period is here immaterial, whether it is shorter or the longer, but what matters is to look at whether this is forming part of the business. Yes, because it is effectively connected to the business, so therefore the rent income arising from letting this particular vacant space is considered as investment income. That is, you have to look at the case, and case by case only. By analyzing, you will have to decide whether it is a investment income or a business income. Now, suppose there is a person, say Mr. Pereira. He has a, say, apartment and 3 houses, say in house 1, house 2 and house 3. And this building he owns as an investment asset. As an investment asset. Investment asset. Now by letting this investment asset, if Mr. Pereira earns rent income, then obviously that will fall under investment income category, but earlier scenario it comes under business income category. So this is how you will have to demarcate, you will have to distinguish an income, whether it is business income or a investment income. So this explanation, this separation is very much important in the computation of business income, because otherwise the way that the business income is liable to income tax is not the same way that the investment income is liable to income tax purpose. So therefore it is very vital to separate these two sources of income in the eyes of the law. Okay. Okay, now since it is very critical concept of identifying this income as business income or investment income, so I would rather happy like we'll have few notes take down in your notebook as to how this business has been defined in the Inland Revenue Act and other important definitions. Now, first you take down a note, say business income. Now, put a dash and say section 6. Now, section 6 of the Inland Revenue Act gives certain guidelines as to how a person should calculate business income for the purpose of income tax. Section 6. Now, this section 6 of the Inland Revenue Act, in explaining the business income, it states what are the things to be included as part of the business income and what are the things that should be eliminated or excluded in the computation of business income. But before going into the technical aspects, but as I explained, now business that you have a fair amount of knowledge about different types of businesses and how the profit and loss calculated for accounting purpose. So, but here you got to remember, for tax purpose, the length of the business or the duration of the business is not important at all. It can be even a 1 day or maybe 1 week, 1 month or years and years. But still, if there is a nature of business activities and if with the intention of making profits, if somebody is carrying on an activity, then that can amount to a business. So that is a very important thing. The length of the business or the duration of the business is not a concern factor to be treated an activity as a business. The second point is the volume of transaction. So there need not to necessarily be a series of transactions or volume, a large number of transactions in order to treat an activity as a business. But even a single transaction, if it is carried out with the intention of making profit, So then it can lead to a business. So these are very important points, but better you take it down under business income in point form. The first point, in deciding an activity, as a business, in deciding an activity as a business, comma, in deciding an activity as a business, comma, the length of the business is immaterial. The length of the business is immaterial. Second point, the volume of transactions is also disregarded. The volume of transaction is also disregarded. Okay, remember these 2 points very clearly. And then we will take down this how the profit or loss from a business is computed. Profit or loss equal income minus expenses. This is how generally we calculate the profit or loss from a business. Now here I'm going to discuss, or I'm going to remind or refresh your knowledge how you have calculated profit or loss for the purpose of accounting. You see, Mr. Pereira, comprehensive income statement, for the year ended 31st March 2019. Okay. Now we start off with sales and then minus cost of sales, and then you have gross profit. Gross profit. And then you add other income. So what I will take it here, what you generally take under other income. Interest income, dividend income, rent income, maybe commission income, profits from disposal of PPE, property, plant and equipment, and then donation. Here donation, what is coming under other income is the donation received, so therefore I need not to necessarily say donation received, but anything coming under other income which is implied and understood, donation received. So now these all other income will come under other income category, and you take the total here into the second column and you add that with the gross profit, and then you minus or you deduct all the expenses. Generally in accounting you classify expenses based on various methods such as administrative expenses, distribution expenses, other expenses, and finance charge. So now I'm not going to take those classification, but we will look at what these expenses in general. So you may deduct salaries and maybe electricity, telephone, maybe traveling, stationery, maybe printing, postage, there may be entertainment expenses, advertising, legal expenses, legal fees, audit fees, and bad days, provision for doubtful debts, say gratuity. So you wouldn't have studied gratuity for the purpose of accounting, but you know basically gratuity you have studied in second stage for your subject commercial law. Under commercial law you have studied what is gratuity, the legal aspects and the legal background of gratuity payment. But in taxation also, under employment income, I have discussed how this gratuity received by an employee who leaves the organization after completing 5 years, how it is taxable. So here, now I will explain how this gratuity is adjusted. But here for accounting purpose, what the gratuity comes into the income statement is a provision. So I would rather happy here to mention provision for gratuity. So then it will be easy, because it is not required so, but still for you all to understand, I will say provision for gratuity. So then it's not an actual expenditure, it's just a book entry, provision for gratuity. Provision for gratuity. So stock losses, and then loan interest, OD interest. So there may be bank charges. But I have taken all these expenses without classifying. But in accounting, you classify under different headings like administrative, selling and distribution, finance, and other, so and so forth. So Now we'll take the total of these expenses and then take into the second column, and when you minus from this figure, so you ended up with profit for the year. Profit for the year, or in other words you can say profit before tax. Profit before tax, PBT. PBT. Profit before tax. Okay. Now this is how you have or you calculate profit or loss from a business. So this is in the income statement. This is how you have done in the past. But now if you look at this profit or loss, what is reflecting, or the bottom line of the income statement, does this comply with the guidelines issued under the Inland Revenue Act in calculating the business income? What the Inland Revenue Act says, business income, when you calculate, you should consider the receipts or income from that business and the expenses incurred to generate that business income. And it can not have any other receipts which are not forming part of the business, or which cannot be considered as part of the business income, or you cannot deduct any expenditure which you have not incurred to generate that particular business income. So therefore it is very vital when you look at this accounting profit or loss, there obviously you have considered, now when you look at this bottom line, that profit reflects this other income as well. Now this is where you will have to see whether all these other income is effectively connected to the business. It's part of the business. If not, you cannot consider this income as business income or as part of the business income, because it's nothing to do with the business. Even if the business is there or not, this income will be there. So you need not to have necessarily to conduct a business activity to generate this income if these are not part of the business. So therefore, what you got to do is, when you calculate business income for income tax purpose, anything that will not fall in part of the business income, those items you need to remove. You need to take them out or eliminate in the computation of assessable business income. We will look at how the assessable business income is computed. Generally what happens, now we take this accounting profit or loss, and then we convert this accounting profit or loss into assessable business income by making relevant adjustments to the accounting profit or loss already calculated. Okay. Now I explain now here interest income, dividend income and rent income. Now if none of these income can be related to your business, or those are effectively connected to the business, then obviously you will have to take them out. You have to cancel these. Cancel these from this profit or loss. But there you have to be very critically analyze how the organization or how the person has earned this interest income. As I said earlier, as I explained earlier, if this interest, what is there in the income statement, is not from any investments such as treasury bills, treasury bonds, fixed deposits or debenture investments, suppose this interest is mainly from charging on the outstanding debt balances, or maybe in granting loans to employees if the company has, or if the organization has charged interest, then those interest on staff loans or on outstanding debt balances are purely part of the business income, purely connected to the business. So therefore, those types of interest income you cannot remove, you should not remove. Only what you had to remove, which are not part of the business or not effectively connected to the business, then you will have to remove, or you will have to cancel from the accounting profit in calculating the business income. Because I said earlier, you start from this profit or loss and then you make adjustments. Make adjustments means either you have to minus or you have to plus. Now in this case, if this interest income is from fixed deposit investment, then in the accounting profit that interest income also will include in the business profit. But for tax purpose, your business profit cannot include any other income such as investment or other income which are not effectively connected to the business. So therefore, you have to remove those types of income. So that is one thing you got to remember. The other one, the expenses. Now, the fundamental principle in taxation in recognizing expenditure, what the law says, you can deduct expenses which are incurred in the production of income. Any expenditure incurred in generating income can only be deducted in calculating assessable business income. Remember, what do you mean by business income or the assessable business income for tax purpose? Again, it is same as profit or loss from the business. But it's not the same way that you calculate for accounting purpose is calculated for tax purpose. Tax purpose is very particular what is business and what business activities are. And it cannot have any other activities which are totally not relevant to the business. So therefore, here we consider all the business related income and business related expenses. So therefore, when calculating the business income for tax purpose, what we calculate is same profit or loss from the business as in the case of financial accounting, but not in the same way that the profit or loss is calculated for accounting purpose, but in different ways in line with the guidelines or the provisions of the Inland Revenue Act. There it is very particular and very concerned what is business income and what expenses can be deducted in calculating the business income. That's very important point you have to remember. Okay, now going back to these expenses, I said the fundamental principle in taxation in considering the expenses in arriving at the business income, whether such expenses have been incurred, in the production of income, in generating the income. If so, then yes, you can deduct those expenses. But if those expenses have not been incurred in generating revenue, business revenue, or the business income, such expenditure you cannot allow, you cannot deduct. Now we will have to look at these expenses that have been already deducted for accounting purpose, like salaries, electricity, telephone, traveling, stationery, printing, postage. Now these expenses, and there is no doubt, so we need not to have any ambiguity as to whether these expenses are incurred to generate the revenue, which is quite clear, which is very much clear. Without incurring these expenses, without paying to employees, you can't get the labor. You can't get them to work for you. You have to pay them. So then salaries is an essential expenditure to be incurred in generating revenue. Not only that, other overheads such as electricity, telephone, and transport, all these things are important and required to incur just because that you are carrying out a business. If you don't have a business, then you need not to incur these expenses. So therefore, if you are conducting a business, there is no wonder and there is no questions. Obviously, you need to incur these expenses in order to make sure that you generate revenue from that business. So therefore, there is no question. But the question here is entertainment. Now, the entertainment expenses, for accounting purpose, in the eyes of accountants, you consider as an expenditure incurred in that business, and therefore you deduct. But for tax purpose, what you really look at is whether this expenditure is incurred in the production of income or not is not the point. Because in the Inland Revenue Act, in computing assessable business income, for the purpose of deductibility of expenses, there are certain guidelines given. In that context, there are few sections important. Those are section 10, section 11, and section 12 to 19. Now, section 10 is the general deduction rule, and section 11 is the main deduction rule, and section 12 to 19 are specific rules with regard to the deductibility of expenses. We will look at those in detail later, but in fundamental, what you got to remember, the expenses that you can deduct is only the expenses incurred in generating the income. So you better make a note here also after this two main points what we have already taken up. Say assessable business income. Assessable business income. That is a subheading. Assessable business income. Assessable business income. Under that say in accounting, profit or loss. In accounting, profit or loss is computed in the following manner. You take this formula, profit or loss equal income minus expenses. Okay. And in a para write down, however, for the purpose of taxation, profit or loss is also computed, but not in the same way as financial accounting, but in line with the provisions of Inland Revenue Act. in taxation, in taxation, in taxation, profit is called as assessable business income. Profit is called as assessable business income, while loss is regarded as assessable business loss. Assessable business loss. Assessable business loss. So remember, in accounting we simply say profit or loss, but in taxation we don't use profit or loss, but we call as assessable business income or assessable business loss. If there is a profit from the business for a given year of assessment, then we say it is assessable business income. If the business has resulted in loss for the year, we say it is assessable business loss. Assessable business loss. Okay, but the calculation, as I said, it is subject to the provisions of the Inland Revenue Act. But same way we calculate, but you got to look at the guidelines given in the Inland Revenue Act. Okay, you better take down this income statement, and then we will see how this profit or loss is later converted into assessable business or loss. First you take this income statement. Okay, now we will see, for the purpose of income tax, how you calculate assessable business income or assessable business loss. Can say, Mr. Pereira, computation of assessable business income and 90. So you have to write the name of the person who is conducting the business, and what you are computing is computation of assessable business income. Now here the heading, you need not to say assessable business or assessable business loss, because we never know what you will end up having. So therefore you just simply say computation of assessable business income for the year of assessment 2018-19. You have to state the period for which the computation is done, and then plus minus. Now we call this table as plus minus table, and our starting point is this bottom line of the income statement, this one. Okay, the bottom line of the income statement, that is profit or loss before income tax. You can say profit or loss before income tax. You take this figure here. Now here what we are going to do is what you have learned for bank reconciliation statement. You start with either the bank statement balance, or maybe the cash book balance, or maybe adjusted cash book balance, and you are going to arrive at the other balance. So here also, but in that context, when you prepare the bank reconciliation statement in one given one given point of time, you will be, perhaps you may be given both the balances. So either the bank statement, both the balances, like bank statement balance as well as the cash book balance. So you have the option of choosing one of them as the starting point. But sometimes only one balance, then you have to start with that balance. But here, always, you have only the accounting profit or loss, and you have to start with the accounting profit or loss, and your objective should be to find out the assessable business income or the loss by making adjustments to this accounting profit or loss in line with the provisions of the Inland Revenue Act, in accordance with the provisions of the Inland Revenue Act, in the context of income as well as in the context of expenses. Okay? So fine. Now, since I have explained little bit of these items, now suppose you have started from profit or loss before income tax, and this profit, what if this profit that is from this, say, Mr. Pereira's business, we'll assume Mr. Pereira is conducting a trading business, or maybe a service business, or maybe a manufacturing business. So there, if it is a trading, say buying and selling, maybe buying and selling of garments or mobile phone or maybe stationery items, so then can you consider the interest income from fixed deposit or maybe from treasury bills or treasury bonds as part of your business income? I said, obviously, for a business like trading or manufacturing or provision of services, interest income from fixed deposits or treasury bills or treasury bonds or corporate debt security investment is never going to be part of your business income. But in accounting, they would have taken up as part of the business income. So therefore, what you got to do is, you had to remove interest income from investment. I will say interest income. So here you have to make a note why you are cancelling. You have to say, I will take interest income from FD, from fixed deposit. Just one example, interest income from fixed deposit. You can say, because that is reflecting here in this accounting profit. What you have to say here, cancel. Why you are cancelling? Because this interest income from fixed deposit, what is included here, is not business income, and we are going to calculate assessable business income. So therefore, it cannot be forming part of your assessable business income. It is not part of the business income. It is totally its investment nature. So why you are cancelling? Not a business income. Not a business income. And an investment income. So then you can cancel out. Cancel means you are removing from the profit that is included this interest income you are removing. So then you have to minus. So likewise, if dividend, of course, obviously investment income, dividend also you can cancel out. Dividend income. You can say cancel. Why you are cancelling? Not a business income or business receipt. You say not a business receipt. Not a business receipt. But an investment income. Now this explanation, if you can give at the exam also better, because just to make the examiner understand that you have a clear idea about the treatment on various items of income. So here dividend income also then you can cancel out. Okay. Likewise, any income which cannot be considered as part of the business income or part of the business and which are not effectively connected, so you can remove. But then again, as I said earlier, so if you have earned interest income from charging interest on outstanding debt balances, or maybe in the event of granting loans to employees, certain organizations they offer or they grant loans to employees, but they charge a nominal interest or maybe lesser interest than the market interest. So then that interest is part of the business income. But that's not investment income at all. So therefore, such part of interest income, you need not to remove it. You need not to adjust there because it is anyway not because of anything else, but because of carrying on. Because of conducting the business, only you earn this interest income. So therefore, it is quite clear. You will have to look at how this income is earned, and accordingly you have to judge whether it should be considered as part of the business income or not. Okay. Now we looked at how you adjust or how you treat income, various types of income for the purpose of income tax. Okay. Now let us take expenses. Now the expenses also, but I will show you this computation, but later we will have to discuss in detail the treatment of expenses for the purpose of income tax. Now obviously as I said, the expenses, what you can claim for tax purpose in calculating assessable business income is the expenses incurred for the production of income or the expenses incurred to generate the business revenue. So now salaries, electricity, telephone, traveling, stationery, printing, postage, these expenses, the question is, there is no question at all, because obviously without these expenses being incurred, you cannot generate revenue. You cannot make revenue. So therefore, these expenses are incurred to generate the revenue. So therefore, you need not to make any adjustments. You need not to necessarily make notes here also saying these are expenses incurred in the production of income, because which are very, very clear and it is understood to any person. Without these expenses being incurred, no revenue, no business revenue can be earned. So therefore, you can just leave it out, these expenses. But I took this entertainment expenditure. Now, in the Inland Revenue Act, in considering expenses in the computation of assessable business income, there are certain guidelines given. As I said earlier, there are few sections elaborates the restrictions and limitations with regard to claimability or deductibility of expenses. Now, the fundamental rule, as I said earlier also, expenses incurred in the production of income can be deducted. Now, you will have to look at whether these entertainment expenses is incurred in the production of income. That is the question. Now, some or maybe certain organization may argue the entertainment expenses incurred in the production of income. Why? Because certain organization provide or offer certain benefits to customers. Maybe the best customer, or maybe the now suppose large organization like Melbourne, Munchie, or maybe Damro. Now what they do is they sell their products throughout the island across distributor network. So then their immediate customer is not the end consumer but the distributor. So in order to encourage distributors to sell more products, higher volume, the company can offer, or Melbourne or Munchie can offer, or can give them tasks saying the best distributor or the distributor who has reached the highest level of sales for a given year will be given maybe foreign tour, or maybe even a weekend stay in a hotel. So these are kind of entertainment expenses, but the motive behind in giving these benefits to customers is to increase the revenue. In that context, one can argue these entertainment expenses should be allowed for the purpose of income tax as an expenditure in the computation of assessable business income. Whatever the argument is, as per the law, it is very clear, Inland Revenue Act specifically says no entertainment expenses can be deducted, which does not mean that you cannot entertain anyone. You can entertain anyone. Any business can entertain anyone, and there is no restrictions to entertain any customer as such. But what the law says, the expenditure incurred in entertaining a person cannot be deducted as an expenditure. That is what you got to remember. Because don't come to wrong conclusion saying the law prohibit or prevent organization entertaining customers or employees, which is not the case. But any expenditure in the nature of entertainment is not allowed for the purpose of income tax in ascertaining business income. So therefore, in accounting, if you have deducted entertainment expenses, what you got to do is simply you have to add it back. You have to say entertainment expenses. Entertainment expenses. You can say cancel. Or rather, not cancel, you better say disallow. Disallow. Law does not allow you to deduct entertainment expense as an expenditure incurred in the production of income. Disallowed. You can say actually specifically disallowed, because law specifically disallowed. Specifically disallowed. Specifically disallowed. Okay. So if the law specifically disallowed, then you have to add it back. You have to add it back. Okay. And then comes to this bad debts, provision for doubtful debts, provision for gratuity. Now, we'll leave for a moment the bad debts, but we'll come to this provision for doubtful debts and provision for gratuity. Now, I told you, provisions are not actual expenses. In accounting, to be in line with the prudence concept, you make provisions for anticipated losses. So, that is in accounting. In accounting, yes, you can go ahead with the prudence concept and make provisioning for anticipated losses. But for the purpose of income tax, these anticipated losses cannot be considered as expenditure. So you cannot book an expenditure which is not incurred. So therefore, no provisions are allowed for the purpose of income tax in computing assessable business income. Specifically, law says no provisions are allowed. So you can say provisions for doubtful debts, provisions for gratuity. You can say specifically disallowed. Specifically disallowed. Specifically disallowed. So then you have to add them back. Add them back. If these items have been deducted in arriving at the profit or loss from profit or loss before income tax, then you had to add them back. Another point what you got to remember, in the computation of assessable business income, what you can deduct is the revenue nature expenses, but not the capital nature expenses. Section 11(1) of the Inland Revenue Act says you can, or rather Section 11(2) says you cannot deduct any expense in the nature of capital. So therefore, recurring expenditure, or in other words, in accounting what we call as revenue nature expenditure, can only be deductible. Now, generally in accounting also, the capital expenses are not treated as expenses, those are treated as assets. So therefore, it's very rare that you need to make adjustments for capital nature expenses in the computation of assessable business income. But in any case, any capital expenditure has been charged to the income statement, you will have to go through the income statement very carefully and identify any expenditure, if it is in the nature of capital and deducted for the purpose of tax, you will have to add it back. So I just simply say capital expenses here. You can say disallowed. You have to add it. And further, now in accounting you make certain payments. Now remember, when you make payments in accounting, all the payments cannot be considered. Now all the payments that you are making cannot be considered as an expenditure. Why I am saying so? Because sometimes you make a payment to acquire an asset. To acquire an asset. Sometimes you make a payment to settle your obligations or to settle your creditors. Whereas you have incurred the expenditure in one accounting period, and in the subsequent accounting period you make the payment. You settle it. So when you settle, so the payment does not go to the P&L. Payment goes against the liability. And when you purchase an asset like property, plant and equipment, so where there is a payment, a cash is going out, but there is no corresponding expenditure, but you will have an asset. So therefore, always remember, every payment is not an expenditure. But now say for example, you have taken a loan and you repay the loan. When you repay the loan, that is a payment. The repayment is a payment, but that repayment goes against the bank loan liability. So in the same way, when the gratuity is paid, gratuity, I have already explained to whom the gratuity is paid is for the employees who are leaving the organization after completing 5 years of service. So now, what happens in relation to gratuity, generally gratuity liability arises to an entity only after 5 years. But if you book the expenditure in the 5th year, there may be a huge amount going into the P&L as an expenditure. Whereas actually the 5th year liability should be spreaded over the 5 years. The reason is this, though the liability arises only in the 5th year, but that liability is accruing every year from the day one that the employee has joined the organization. So therefore, in line with the prudence concept in accounting, you make provision for gratuity. And that is why I said here, provision for gratuity. It's just a book entry, and that is not an actual expenditure. But actual payment, once you book the expenditure, actual payments comes into the scene only at the time that the employee leaves the organization after completing 5 years. But remember, at that point of time, when that employee leaves the organization after completing 5 years, you make a payment to those employees who leave the organization, and that payment will not go into the P&L. It will have no impact on the P&L. The reason why, by the time when you make the provision, you make the provision by debiting the gratuity account and crediting the provision for gratuity account. By debiting the gratuity account and by crediting the provision for gratuity account. So then, by the time when the employee leaves, you make a cash payment and you can credit the cash, and since you have already provisioning account, you can debit the provision account, and then provision accounts will get set off. So then there is no impact on the P&L by the time when gratuity is paid in cash. But remember, we disallow this gratuity provision, saying provisions are specifically disallowed because those are not actual expenditure. But for the purpose of income tax, when you make the cash payment for those employees who are leaving after 5 years, that cash payment has to be considered as an expenditure for income tax purpose. So in that context, you will have to take gratuity paid in cash as an expenditure, as a allowable expenditure. Gratuity paid in cash. Paid in cash. This is not reflecting in the P&L. So in this P&L, the profit or loss calculated before income tax does not reflect gratuity paid in cash. It can never come into the P&L. Even though it does not come into the P&L, since the provision is disallowed, by the time when the provision is made, the cash payment has to be allowed for income tax purpose. You can say gratuity paid in cash allowed. Allowed. So allowed means you can deduct whatever that you paid as gratuity to those employees who left the organization. Okay, so likewise, you make these adjustments plus minus, and after making these adjustments, you can total up both these columns separately. So plus column total you take separately, and the minus column total you take separately, and see which column is higher than the higher. And if the plus column is higher than the minus column, you can say assessable business income. Assessable business income. Income. Assessable business income. If the minus column is more than the plus column, that is assessable business loss. Accessible business loss. We will see if there is accessible business loss, how it is to be treated. So, okay, you better take this down. Okay, now we will take the treatment of expenses in the computation of assessable business income. So you can have a heading, treatment of expenses in the computation of assessable business income. Treatment of expenses in the computation of assessable business income. Under that, say in the computation of assessable business income, in the computation of assessable business income, comma, in the computation of assessable business income, comma, treatment of expenses is very vital, The following main provisions are applicable. The following main provisions are applicable in deciding as to how expenses are taken up, comma, in the computation of assessable business income. Okay, you can take down one by one. General deduction rule. Put a dash and say section 10. And then second one, main deduction rule. Put a dash and say section 11. And then specific deductions rule. A specific deduction rule. Okay. Now we will take the general deduction rule. So I have a subheading general deduction rule. Okay. Now, as I explained, in considering the expenses in the computation of assessable income, so you need to be very careful and you need to be very knowledgeable about the provisions or the guidelines given under these different sections. Now the first is the general deduction rule, and you have already taken down the subheading general deduction rule, and under that say section 10(1)(b), section 10(1)(b), section 10(1)(b) of the Inland Revenue Act states, section 10(1)(b) of the Inland Revenue Act states the following expenses are specifically disallowed. The following expenses are specifically disallowed in the computation of assessable business income. So you can write down what those specifically disallowable expenses one by one. First one, domestic expenses. Within bracket you can say personal expenses. Private expenses. That should be within bracket. And then give some example. Residential electricity bills of the sole proprietor. Residential electricity bill of the sole proprietor. So any expenditure which is in the nature of personal cannot be deducted. And then the second expenditure, which is not deductible, specifically tax payable under the Inland Revenue Act. Tax payable under the Inland Revenue Act number 24 of 2017. Tax payable under the Inland Revenue Act number 24 of 2017. Next one, third expenditure, provisions also specifically disallowed. Provisions cannot be deducted. You can give examples: provision for doubtful debts, provision for gratuity. Enough. Provision for doubtful debts, provision for gratuity. And then entertainment expenses. Entertainment expenses also specifically disallowed. And then the next one, interest, penalties and fines. Interest, penalties and fines payable. Interest, penalties and fines payable to a government. Of any country. Interest, penalties and fines payable to a government of any country. For breach of any written law. Here you have to be very careful. These interest, penalties and fines, what is payable to a government of any country is what is disallowed. It does not mean that now interest paid on a bank loan or penalty interest paid on a bank loan is not covered here. And then the next expenditure related to exempt or final withholding payments. Exempt or final withholding payments. I will explain these things later. Dividends. Next expenditure, dividends. Next expenditure, transfers to reserve. Transfers to reserves. Contribution to retirement pension fund, which are not approved by the Commissioner General. Contribution to retirement fund which are not approved by the Commissioner General. Okay, these are the expenses which are specifically disallowed for the purpose of income tax under section 10(1)(b). Okay, so we will have a break and continue.